Okay, so I wanted to answer the question about Roth IRAs and specifically doing a conversion from a traditional IRA to a Roth IRA. So, this can be a very effective tool for tax savings. Here's why. So, the traditional IRA works such that you put the money into the account tax free. You don't pay tax, essentially get a tax deduction. You don't pay tax, the money goes in the account, it grows tax free, but then when you take withdrawals, you pay tax on the withdrawals. The Roth IRA is such that you make your money, you pay tax, you put the money in the account, and then it grows tax free. But when you make the withdrawals, you don't pay tax on the withdrawals. So traditional is no tax today, tax tomorrow. Roth is tax today, no tax tomorrow. Now, why you would choose one or the other depends on a few things, namely how much money you make in a year, how much tax savings you get, and so on and so forth. Here's the thing: you can eventually convert some of your traditional IRA funds to a Roth IRA. When you do this, though, you essentially create taxable income for yourself. So you didn't pay tax on the traditional IRA funds when they went in. Now that you're converting them, you have to pay tax on this converted amount, like regular income. But now going forward, when you withdraw those Roth IRA funds, you don't pay tax on the withdrawal. This can be really a helpful thing in this example. So say, for instance, you're making good money, like myself, I've done this. You're in California. When you put money in a traditional IRA, you get a significant tax break. You might get 25, 30% on the federal and upwards of 10% tax break on the state. So you're making, for every $10,000 you're putting in there, you might get $3,500 in tax savings. Definitely worth doing the traditional. Now, cut to a few years later, you decide to go on a sabbatical, right? You make no money in a year. Well, if you went and converted some of your traditional IRA funds to a Roth IRA in that year, and say you and your wife converted $30,000, well, you each get the standard tax deduction plus, depending on your taxes, other deductions, and you could probably make up to $30,000 or $40,000 in a year as a married couple without paying any tax. Well, when you do that Roth conversion, you're going to log that conversion as income, but because you're not making other money in that year, you will be paying tax at either a lower rate or potentially no tax at all, because you're within your standard deduction. So now you've taken the conversion in a year your tax scenario is more favorable, and you've converted that money into a Roth so that now when you start doing the withdrawals, you don't pay tax on the withdrawals. Another time you might consider doing it if the market's greatly down and you potentially have the favorable tax year for whatever reason. You can transfer shares from a traditional account into a Roth account, like mine are at Fidelity, so I was able to just move shares like kind without selling anything, and you get the conversion value at whatever the value of the share is today. So if the shares are down, I don't know, 30% or something, you're doing a Roth conversion on a stock that is currently down that you think in the future is going to go back up. So you essentially take additional advantage of the fact that maybe things are down. You're not going to be selling them, they're long-term investments, but if you're going to do that Roth conversion and pay the tax, you're going to get it at a lower, not a lower tax rate, but a lower gross amount of money that you're paying the tax on. So that's a scenario in which doing a Roth conversion would be a good thing. Now, some pitfalls you want to look out for. Well, really, the main thing is truly understanding that when you do the conversion, you're going to be adding taxable income to your tax return for that year. So you want to make sure, again, you're doing it in a year where you're balancing, the benefit versus the tax you're going to pay in that year. If you're having again, if you're in California and you make a lot of income, you may not, there might be no good reason to do the Roth conversion because you're just going to pay a ton of tax on it, you know? So it's just part of your overall tax planning and long-term investment and, retirement planning strategy. And if you want more information about that long-term planning strategy, I have some articles on my website. One's called the Financial Independence Roadmap. That actually even leads into a course that you can buy where I have spreadsheets on how to map out your whole roadmap to retirement. And some of these types of considerations are part of that process. All right, thanks so much. Talk to you later.